So I'm Agnes Chen, Managing Director for CSC APAC Services for funds and incorporations in Asia. I will actually like to thank everybody for being here today, as well as our distinguished guests and speakers. I will go through an introduction of everybody in terms of their names, etc., and allow them to introduce themselves before coming back to me to start the panel. So we have Brooke Zhou from LGT Capital Partners today. We have Chuan Tor, co-founder and managing director of Alpha Partners. Jim Xiao, chairman and head of China Primera. Joe He, managing director in China, CEO of Australian Capital Equity. Gong Jie, who is a partner at Pantheon, and Xia Wang, executive director of GCM Governor. So I would like to invite Brooke to start introductions of herself.
Thank you, Agnes. It's good to be here. My name is Brooke. I'm a partner at LGT Capital Partners. A quick introduction on LGT. We are a global fund of funds manager, currently managing about 60 billion in assets. About a little over half is in private equity. We've been investing in Asia since 1999. We have over 3 billion put to work in this region. China obviously is our largest region in terms of our investment activities here, over 50%. So obviously really tracking the landscape very closely and happy to be here. Thank you.
Hi, good morning. I'm Chuan Tor, founder of Alpha X Partners. Alpha X is a technology-focused early-stage venture fund in China. Our focus is anything related to AI, so data mining, and also 5G. Personally, I started my career as a tech venture capitalist since 1995, working in Tokyo, Palo Alto, Boston, Shanghai, and Beijing. So now I'm based in, our office is based in Beijing. Thank you.
Thank you. Hi, this is Jim Cao. I'm the chairman and head of China for Primera. Primera is a global GP. Currently, we are investing with 2 funds, total $14 billion. And I myself has been in the private equity business for 15 years now. And before that, I was a CEO of a Hong Kong listed company. Thank you.
I'm Joe from Australian Capital Equity. We are a private investment group headquartered in Perth, Australia, with diversified assets in media, energy, mining, real estate, and alternative investments. And we've been investing in China for the past 20 years.
Good morning, everyone. I'm Gong Jie. I'm a partner with Pantheon. Pantheon Ventures is a global private markets fund of funds. Our business spans from private equity, infrastructure, real asset, and also private credit. So a wide range of private market areas. We have been in the region for the last 26 years, so a very long history, and have invested across a wide spectrum of investment stages and with many relationships with both venture firms and private equity companies. So very good to be here.
Hi, my name is Wang Xia. I'm from GCM Governor. We are an alternative investment manager. Founded in 1971, we are one of the oldest alternative investment firms globally. Today, we manage about 57 billion assets on behalf of our clients. We target almost everything within alternative space, ranging from hedge funds, private equity, infrastructure, and real estate. Private equity takes account the largest part of our private markets investments. And we have been active in investing in China since mid-2000s, and it's been one of the focusing areas for the Asia team here. Thank you.
Thank you very much for the speakers' introduction of themselves. So I represent CSC Global. CSC Global is a 120-year company. We actually service and structure investment structures for 90% of Fortune 500 companies. We are actually in APAC, Singapore, Hong Kong, Shenzhen, Shanghai, etc. So to start the panel itself, it's very interesting because China has been a very leading power in the region and in the world itself. And we have a prediction report from one of the big fours early this year that the asset management hubs in Asia will gradually grow, and now we have Singapore, Hong Kong, etc. Shanghai is nominated to be one of them, increasingly in power in the next few years itself. Asia is expecting massive growth expected from China's Belt and Road initiatives, etc. And we have already started seeing that a lot of interest into China itself. With all the possible positive impacts itself, we do actually also see in terms of consumer basis, the number of millionaires in China has increased over the years and now have exceeded anywhere in the world itself to be the highest in numbers just in China. So China is definitely an interesting market. But what I want to ask is, because despite that there's a lot of positive growth, etc., there's also a lot of volatility in terms of trade tensions, dampening growth as we speak itself. So I'd like to actually spread across the panel itself. Is China still an attractive strategy for investors? And you have mics in front of you. Please feel free to pick it up and express your thoughts. We have a various mix of panels, so general partners, limited partners, and sometimes both. Please share with the floor in terms of your perspective.
Well, I'm happy to just kickstart on this. Agnes, you talked about a few challenges for the Chinese macro recently, the slowing down of economy as well as the trade tension. I would say that the panelists and I myself included would tend to take a bottom-up perspective. I think all of us would agree that the GDP development is not really it's just a proxy. It's really not a representative growth rate for a very wide range of industries and sectors. And we tend to focus on areas and pockets of the market that have the growth trajectory far superior to GDP growth. And our value add is really in zeroing on those segments of the market and industries that we see as representing the most robust, interesting opportunity set. So it's not really just to take the GDP as the as the only, in a way, conduit for growth in China, but really create a portfolio of opportunities that represent a very good set of growth drivers that are independent of the slowdown. And on the trade tension, I would say that export businesses certainly are at the front line of being impacted, but most of our time and efforts are really on the domestic consumption businesses that do not bear the direct impact of the tariffs. So as long as the consumer confidence remain relatively robust, and that will really create the underpinning of the opportunities.
Thank you. Please go ahead.
Yeah, thanks, Jay. I agree with what you said. So, given the recent uncertainties, we still also believe that China is long-term a good place for investment. It's just we need to adjust the investment strategy based on the different situation that China is facing. So, for example, as I said, we've been investing in China for the past 20 years. And for example, 20 years ago, our investment strategy is to invest in state-owned enterprises. Because back in that time, there are many areas needs the state-owned enterprises to take an important role on it. And 10 years ago, we shifted the investment focus into the media and entertainment sectors because we see the rising demand of the middle class people's demand for the entertainment issues. And 5 years ago, we started to invest in the internet and technology sectors. Although it's not as early as many investors did, but still catch up the late trend of it. So the question is like, maybe what's the next big trend in China going to be? So I think one potential trend could be copy from China. So there are many very good Chinese teams and Chinese companies who has experienced the very successful mobile internet experience in the very competitive market in China with their business model and know-how, and expanded to the emerging market, for example, the Middle East Asian, the Southeast Asian, and Indian, also maybe Africa in the future. So we're now actively follow on those kind of opportunities, and would like to see if those kind of investment in China, is also Chinese company, might generate much faster growth in those emerging markets.
Yes, I agree with what Joe just mentioned. I think if we look at the sectors with the sector, especially the technology sector and then the healthcare sector, I would say we are still very excited about the potential. I'll give you an example, like in 1996, when I came to China, in Shenzhen, we look at the technology company. We used to say like the technology gap between China and the US was over 10 years. China was 10 years behind the US. But in 2006, the gap is about 5 years. But today, we think the gap is getting very close. And in some sector, China actually has been doing much better than the US. For example, like the WIPO, the World Intellectual Property Organization, they have every year they have the data, the patent filing application numbers. It was very interesting in 2013. I would say the patents, according to data, patent filed by Chinese companies was only about 10% of the global market. And the US was about 23, 24%. But last year, 2018, the market share of China increased from 10% to 21%. It's only 2% behind the US. The US is still around 23%. So based on the growth of the patents, probably another 5 more years, we will see China is going to overtake the #1 position. So this is I would say this is something we're very excited about that. And one more thing I want to bring up is that about the quality of the entrepreneurs. 20 years ago, the Chinese entrepreneurs, they actually lack of startup experience and lack of a capital for them to establish new companies. But today we found that many Chinese CEO or the management teams of the startups, they actually have success track record before. They actually brought company IPO on NASDAQ, New York, or in Asia, and now they came back again and they invest a lot in the technologies. So this is something I would say as a venture capitalist, I'm very excited about that. This is something we haven't seen, never seen the entrepreneurs like that 10 years ago. Thank you.
Just to add in a very short comment, just from an LP's perspective, also I want to make the observation. Number one, we're still super excited about the private equity space in China. And it's actually a pretty similar parallel to what Chuan mentioned. If I look across sort of the GP space in China, you go backward 20 years ago in late 1990s or early 2000, actually, the teams that were starting up private equity shops private equity really before then didn't really exist. So there were teams with limited private equity experience. Some of them came from maybe IFC, World Bank, that has some investment experience, some from corporate, some from just a very different set of experiences. But you look at today, right? There, whether it's venture, private equity, growth funds being formed every day, and then you look at those GPs' backgrounds, they all have the perfect combination of being the local team that was grown up and has the language, the cultural background of China, has the connections, but also have the experience and training of sort of private equity by the international standards. They have spent many, many years at a bank, at a private equity shop, and so on. So that combination today is everywhere compared to 20 years ago. And the private equity industry landscape is very, very vibrant. So it's very similar parallel to on the entrepreneurial side. And that's why, coupled with that entrepreneurial landscape that you can see, and coupled with the fact that if you look across all the different sectors in China, and I think you all know this, there's so much more you can do. It's based around consumption upgrade, it's based around infrastructure upgrade in terms of healthcare and so on. So I think you've coupled those two together, it's a very exciting opportunity set.
Thank you, Brooke. Yeah, so I agree because it's very interesting and it's very encouraging to see the growth in China, especially it's leading the market, it's better than before, etc., and it's definitely setting a standard in the world itself. So Jim, I would like to ask you, for example, do you have any advice for the floor in any case if we are looking at a China-based fund, private equity fund, for example, and based on your experience, what do you think, what would be your advice for any risk and uncertainties that investors should look for general partners when they invest into?
As a global fund employee, my views on local fund could be biased. But personally, I have to say I'm very bullish about local funds. All leading global funds, the big names today, KKR, Carlyle, ourselves, we all started as a local fund. So unless they are proven that they can really do well in their home country, they have no place in the global scale. So I think, just judging from the total asset allocation, currently Asia Pacific is about 20 to 25% of the global M&A assets. And when I joined the business 10 years ago, 15 years ago, it was only 10% of the world. So there is a lot to come. But when you look at the situation today, most of the big deals that's taking place in this market are really joined by those international big names. And you look at the kind of funds that the global funds are being able to raise today are mind-boggling. When I joined the business, we raised a $1 billion fund, and we feel we're on top of the world. And nowadays, if you don't have 10 billion, people kind of say, oh, you're a small fund. And the market has transformed so much. So maybe I just talk a little bit about where I see the three major differences between global funds and local funds today. One, local fund is more about EQ, but global funds is more about IQ. 在中国做项目主要是靠个人魅力 ，especially the minority deal， 就是你能不能拿到项目，你什么价钱拿到项目。That's the most important thing. It could be the world's best project, but if you got the entry price wrong, then you're screwed for the rest of the project period. So there is a reason why local funds are more EQ based. And the global fund, because they have to apply the same principle everywhere else in the globe, so they have to be more IQ-based. And it's more of auction-based competition. The second difference, local fund, you pretty much look at the founder. 有几个很出名的我们业界大佬，大家投资是其实投这个人。But you look at the big names, KKR, Carlyle, 铁打的衙门，流水的官。They can switch management many times, but the fund still deliver that result for their investors consistently. And that's probably because most of the China funds are early stage. It's very early in their life. And the third difference is fund life. Fund size. Most of global funds, we're all talking about 10 billion plus, where local funds, we're talking about smaller tickets. Down the road, I think I'm very bullish about local funds, China funds. And I think there will be more and more consolidation into a few big names, just like what's happening in the world, which all our fund of funds and investment advisors are advising, investing into the big names. That there will be a few big names in China emerging. And I think the gap between global fund and local funds will gradually narrow in terms of the approach, in terms of their way of doing business, and in terms of how can they 从人治到法治 whoever can get through those hurdles first and deliver good result, in like every industry in the world, number one in China will be number one in the world. So I'm very optimistic about our colleagues who are running local funds today. But they have a long way to go, but very promising future.
Thank you, Jim. So Joe and Chuan has actually been very passionate about technology, and we've heard that earlier on. And with the growth of internet and technology, etc., how would the panel see in terms of the PE model have changed? How has it impacted the strategy or any results that you have actually invested in?
Okay, so I think this many voice in the market says that the winter is coming recently. And in my view, I don't see this lack of capital in the leading investors. They just become cautious under the current situation. And actually, in the past several years, the surplus of capital has lifted up the price of many assets and created a lot of wind trucks in China. So under this circumstance, should we become cautious on the internet and technology investment? I think one principle that we should follow is whether a company that we are about to invest is a company that could actually solve the unsolved issue and meet the true demand, instead of create the fake demand. So for example, what's the current unsolved big issue is? What's the current very big demand is? I think one of it could be that during the past several years, the continued quantitative easing has created a lot of problems on the house price and create bubbles on several areas. So according to the macroeconomic theory, one way to solve this puzzle is to increase the productivity. So how to increase the productivity is to use the new technology empower the traditional industries. So we are looking at the opportunities that could increase the productivity either by self-development in China, I mean the new technology, either by self-development in China or acquired and adopted from overseas and apply in China, like we do 15, 20 years ago on the internet era. One of the potential countries that we could acquire those technology from perhaps could be Israel or some European countries. So that's my view. I think like going forward, the investment in the technology area perhaps could be around in this area.
Yes, I would say that when we look at the technology sector, there is a significant change over the past 2 years. Because before 2015 or 2016, most of the PE and then the ventures fund, they make investment in the technology sector. The companies they invested, I would say nearly about 80 to 90% of them, they are 2C, to consumer, or they are most of it is business concept based, companies. So they're not actually, so don't need to spend, too much on the technology. It's called internet driven, right? So we have seen that many companies there became the billion market cap. However, I think the last 2 years we started to see that like all this, many of the concept-based internet companies, they burn too much cash and they couldn't achieve, the break even. So suddenly, in our sector, especially this 2 years, we start to see more investor, our peers, we're making more technology-based startup. Even like in healthcare or in the past, 90% of them are actually facing consumer 2C business, but now we see a lot of our peers, including ourselves, we're making investments in enterprise 2B solution, and then also for the technology-driven companies. I would say this is something will continue. It recall my experience of when I was in the Silicon Valley. In the US, definitely we have a YouTube, Google, all this like the internet companies. On the other hand, we still have like the Dropbox, and then we have the like Oracles, all this enterprise company. So I would say that over the next 5 or 10 years, we will see more real technology-driven enterprise, so targets Chinese companies will increase significantly. There's one data again from the WIPO in the AI sector. China's actually file more patents than the US. So this is like a significant change. So especially when we're making investment in the advanced technologies, you talk about like data mining, robotic technologies, AI. The future, the potential is very, I would say is huge. That is something 5 or 10 years ago we couldn't see.
Yeah, I'll add a little bit color from LP's perspective. I would like to address the question really by 2 parts. First of all, from sector perspective, I think internet and technology will continue to be a dominant sector or strategy for most of the GPs targeting China. Actually, according to a recent survey conducted by Bain, 80% of Greater China focused funds are either intend to invest in this sector or already have been investing in this sector. And the reason is very obvious. Over the past 5 years, 80% of the growth is coming from these sectors. And I wouldn't just say, internet and technology sectors, really internet and technology enabled sectors. So that would include a much broader range, including consumption, including healthcare, including education and business services. So within that sector, in the past, I would say like 5 to 10 years, most of the innovations are around business models. And therefore, most of the so-called unicorns are coming from 2C sectors. Going forward with the ongoing trade war, with ongoing trade war, and some of the challenges that China is facing right now, especially like productivity improvement pressures. So I think 2B business and especially on the hard technology front will have some breakthrough. And from investment type perspective, I want to have two comments. One is early stage investments. So if you look at the data, again, in the past 5 years, in the US, about 20%, more than 20% actually, capital are investing in early stage investments. But in China, if you look at that figure, only a little bit over 10% is investing in early stage investments. So I think there are still potential for early stage investors to expand. And also from a valuation standpoint, unfortunately, because the fundraising market, again, in the past few years, the market has been very competitive, valuation has been very high. Last year, the average deal size in the internet and technology sectors reached about 200 million, which is quite large. But if you look at the deals from return perspective, again, there are statistics for companies that are listed in 2017 and 18. On average, all companies actually lost about 21% of their initial market capitalization 12 months after their IPO. By contrast, if you look at companies listed in 2015 and 2016, they actually on average gained 105% of their value after their initial IPO. And more interestingly, actually for companies got listed in 2017 and 18, 61% of the companies actually lost their initial market capitalization by 30%. And if you compare a few years ago, the number is roughly from 5 to 7% of companies would lose that much capital like 12 months after their IPO, which means the return has been squeezed. From LP's perspective, of course, we still would like, China is still a growth market, and we look for higher returns compared to the established markets. So that would force a lot of investors may move more on the early stage front. So another thing I want to address is buyout strategy, and Permira is clearly one of the leading firms on that front. But for buyout in China, we have been waiting for the moment that strategy, to take over most of the market for a while. In established markets, if you look at the U.S. and Europe, especially Western Europe, buyout is definitely the dominant strategy, and the area like managers deploy most capital. So we were expecting that strategy to be more dominant in the past few years, but because of various reasons, the deal flow has been bumpy. But we would say, going forward with the more challenging operating environment, and also much larger management talent pool, we think the strategy may have more room to acquire interesting assets. And also with the regulation change, hopefully, we can see some domestic privatization opportunities as well. So with that, I'll pass over to Gongjie to share some of her perspective as well.
Thank you. I'll just add a couple of points. First of all, I think technology permeates all aspects of investing, whether you're a GP investing into technology companies or whether you're a GP that focuses on a larger set of general industries. Two things from two dimensions. One is risk and the other is really value add. On the risk side, I think today more than ever, you need to assess how this industry could potentially be disrupted and where that disruption could come from. And traditionally, you will have a very clear view of the landscape and who the competitors are for the foreseeable future. But today, there can be curveballs coming from another industry, an adjacent industry, or industry that currently have no overlap with your industry. Enemies can emerge from out of nowhere and coming to your industry. So 跨界思维 is something that everybody needs to develop, because you need to really look around you rather than just within the remit of your current industry boundary. So that actually adds another layer of challenge, but it also becomes a increasing, I would say, a strategic imperative for the GPs to have a technology overlay in their thinking and in their organizational resource to be able to anticipate where that curveball could potentially come from in the companies they invest. And in terms of the value add, a lot has been said about digitalization, which I'm not going to belabor. But I also think that the analytics that go behind a investment underwriting is now dramatically higher, enabled by the abundance of data that can be harnessed to enhance the precision of your underwriting and your deal pricing, because you can use a lot more data from the industry, from the competitors to validate your point of view towards a particular business or particular industry. So that's a very powerful tool that many GPs are using increasingly to enhance their underwriting precision.
Thank you, Gongjie. And thank you for the panel's very, very interesting speech itself on sharing of ideas. So one last question to the panelists, and we open up to the floor if they have any questions, is something very practical. So if you were to look at China-based funds and you're looking at investing, the first question would be, name one element or factor that you will zero into. And another practical question is, have your investments as a GP or as an LP representing both parties, etc., paid off as compared to other investments on a global level? Probably we can start from Brooke.
Thank you, Agnes. It's very difficult to zero in on one factor because it's almost impossible. But if I have to choose one, I think it would be the team. But then that's really all-encompassing, right? If I say the team, then that comes from the perspective of the stability of the team, the capabilities of the team, and that would include their track record from previously. That would include the team's alignment with the LPs. So that would mean, where are they in their fund cycle, how big of a fund they're raising, and how much of their own money are putting into the fund. So if I have to really sort of distill down to one factor, then I suppose that would be the team. So, but I think one thing that I personally, and also as a firm RIC, focuses a lot on is motivation. Assuming you're looking at a fairly even landscape of GPs who are generally fairly smart, fairly well connected, has done deals in the past that have done well. I think there's a lot of those kinds of teams out there now who can have a portfolio of deals that they have done and they have exited and they're all performed fairly well. So then from that group of GPs, then how do you select one or two from them, right? Then I think it just really comes down to motivation. Then the motivation is, are they still motivated to generate that type of returns to their LPs? And then from an alignment perspective, do we have that hardcore alignment with the GP? I think the second question is if our investment strategy in China has paid off compared to other markets, or has it paid off in general? I think so. We obviously have done really well in China overall. We have seen some cases where there's some minority of cases where things didn't work out. And then if hindsight, if we look at those cases that didn't work out, I think it comes down to really motivation. And if we think hindsight about what we missed or what we didn't pay enough attention to, it's motivation. And then if you look at the cases that we have done incredibly well, then it also comes down to motivation. And then frankly speaking, I have the personal view that you could have everything that's has gone well, that you could diligence on everything, but ultimately, at the end of the day, you still need to have a little bit of luck to get to that outsized return.
Great, thank you. Unfortunately, our time is up. I would like to ask the audience on the floor if you have any questions. Otherwise, we thank you for our panelists today and their time.
Jim, I have a question for you. You just said the China funds are at their early stages, and these top tier funds, they consistently deliver a solid and consistent result. So what we can learn for the China local funds from these top tier funds?
I think 我觉得这个两部分，一部分就是第一个市场的需要，因为在国外做项目主要是做 auction， 所以这个事情是很 black and white。中国做项目是你谁能够有这个 charm 去拿到项目，然后用好价钱拿到，所以我觉得以现在来说，这个人是应该是最重要的一个成功因素，但是我们要与时俱进哈。那个市场会有逐步的变，那将来这个 deal 的这个形态也会越来越多 auction， 因为最后那会给卖家提供最好的结果。那在那种交易里面，那整个 team 的 discipline 跟他的这个传承，这个后面有没有人可以接上来，这些都会成为长期来说，这个基金能不能够继续赢下去的一个重要的因素。所以我觉得现在也许还是人最重要。 就同意 Brooke 的讲法，但是往前走，谁能够把它 institutionalize 啊？我觉得就会分出长远的赢家跟短期的赢家。
Thank you, Jim. Any further questions?
Hi, I'm from Grand Realm from Beijing Asset Management. So the topic of this panel is the quest for returns. So I'd like to share maybe one or two answers from the panels regarding the returns. So do you have your projected DPI or IRR in China, roughly, and what is the status? Thank you.
China has hundreds, and depending on how you measure, over thousands of funds. And it's very difficult to really summarize in one bullet point. The disparity of the performance is why people like Xia and Brooke and I myself exist, because we're in the business of manager selection, and manager selection itself creates a great deal of value in a landscape where there are lots of managers and many inexperienced managers. I think that's a good segue talking about sector specialization, which we haven't had a chance to touch upon, but that in itself also creates a lot of value by being able to harvest very deeply into a particular sector. So going back to your question, DPI is an area that all of us are laser focused on in generating, because that's about money returning the full cycle into the pockets of the investor. I think as a asset class, because of the large expansion the Chinese PE industry has seen, DPI has historically been lagging behind as an entire sub-asset class. But that's not to say that the subset that are ultimately lending our portfolio have delivered very good DPIs, because that's a factor that we use as a top screening criteria for our selection. So difficult, you can look into the Preqin data and the Cambridge Associate data that give you some insight. on what the DPI profile looks like depending on the vintage year. But it's as a single number, it's extremely hard to crystallize. But I would say if you stay with the top quartile, top decile managers, then the return from TDPI and DPI are very strong for the Chinese managers.
Thank you very much. With this, we end our panel discussion. And if you have any further questions, I urge you to contact or meet with the panelists later during the break to discuss a little bit more on your questions. Thank you.